Hi, Niro Pillay here from Investment Rise. And if you've been watching the market, you know that things are starting to change in our two hottest markets. Sydney and Melbourne for the last few years have had record runs, but we're now starting to see things change. We're now starting to see reports of flat growth over certain months. We're starting to see reports of higher vacancy rates and oversupply in the apartment market. So what does all that mean? Well, if you've been reading the reports, many are now starting to predict that the Sydney market, obviously, yes, the growth rate is going to slow. I think everybody would agree on that. And in many ways, I think that's a good thing because a few years ago, 4 years ago, our median price point in Sydney was $650,000 and nobody thought that was cheap. Today, it's $1,050,000, so $400,000 growth in about 4 years. And that's on average, so it's been more in many areas. If that was to continue, that would mean that in another 4 years' time, our median price point would be around about $1.5 million. Who's going to be able to afford that kind of property? So I'm not disappointed at all that the growth rate is slowing. However, the key thing is if you're an investor, if you're looking to enter the property market in 2017 and in the coming years, you need to start thinking differently. Because a lot of people are starting to say, look, we're going to go flat, we may even have a slight correction. Now, no one's talking yet about a crash yet. I mean, yes, there are your doomsdayers, and look, I don't give them much heed, but there will be a correction. And we're talking at the moment, the biggest correction anyone's talking about is 7%. Well, that's not a great deal because if you bought even as long 12 months, 18 months ago, you had 12 to 15% growth. So your property is still going to be worth more than you paid for it. But if you're entering the market today, things are different. Because see, when you buy a property, you're immediately about 4% behind the 8 ball. Why? You've got your stamp duty costs, you've got your legals, you've got bank fees potentially. So when you take out all your costs, you're already 4% behind the 8 ball. And then what happens if property drops 7%? Well, let's have a look at it on the board to look at the figures, because I think this is going to really point out to you why a 7% correction, if you've got property held it for a few years, neither here nor there for you. But if you're looking to enter the market, it's very, very different. So let's say, for example, you look to buy a property for about $700,000. Okay, now that price point you're looking at the apartment market generally. But let's look at that. So, as I said, moment you enter, you're down 4%, so negative 4%. All right, with stamp duty and everything else. Now, let's say the market drops 7%. As one of the major finance institutions come out and spoken about. Well, that's a drop of, in total, 11%. Well, what does that mean? You buy a property for $700,000. That means if you were to sell, and yes, this is only a loss if you were to sell, absolutely, but let's still look at it. 11% means that you would have lost $77,000. That's what you're down at the moment if this was to transpire. Then, however, it gets worse because with Sydney's rental yields currently at really, really low levels, the rent you're receiving almost certainly will not cover the mortgage if you're buying a property this year. So therefore, you will have to keep topping up that mortgage every month to fund the gap between the rent that you receive and your interest payments and costs. So let's just say that you're topping it up for, you're negative, say, $400 a month. Okay? Now, you're probably negative a lot more than that, but again, let's be very, very conservative. So that would mean that you would buy a property, and if things work out the way everyone's talking about, it drops in value, so you lose $77,000. Yes, it's a paper loss, but you still don't have access to it. And then every month, you've got to pay $400 a month per more, just to hope and pray that somewhere down the track prices rise and you get that $77,000 back plus more. Okay? So put it another way, imagine if I asked you to give me $77,000 and I'm going to keep it, and I'm not going to tell you when you're going to get it back. That's uncertain. Oh, and I'm not going to necessarily give you interest on that money. No, you're going to pay me $400 every month just to hope and pray that I will give you back that $77,000 in the future. And if you think that's a good deal, you need to call me right away because I'll make that happen for you. But in all seriousness, that's what you're looking at. All right, so this is why people who are the new buyers, a major concern for people in the property market in their two major hot markets of Sydney and Melbourne, are people who bought in sort of 2016, 2017. Because this is a very realistic scenario. It's not going to affect the person who bought in 2012. They couldn't care less. They've already had 40% growth, dropped 7, they're still miles ahead. So if you're looking to enter the market, you've got to consider, is this really what you want? Would you give away $77,000 and keep paying money every month just to hope you get it back down the track? That makes no sense to me whatsoever. So if this is the situation, does it really seem like you should be following this path? I mean, auction clearance rates are dropping, but what you look at that, if you look at the auction clearance rates, they're below 80% right now on average. But look at the price points or the areas where the price points are around $700,000. So your Western Sydney, maybe Southwest, those auction clearance rates are now sitting at 50% or lower. That's really, really low. And that's going to cause problems going forward when the heat comes out of the market. So I really believe that in 2017, you've got to start thinking differently. What worked before is not going to work going forwards. What do you think you should do differently to stack the odds of success in your favor when looking to buy property in 2017? There are still some great opportunities out there, but you need to do things differently. I'd love to know what you think. Bye for now.